So the Tax Cuts and Jobs Act, a majority of the benefits were targeted to corporations and small businesses. We're going to more so speak about some of the benefits on for individuals like yourselves. And individual taxpayers are affected in 4 ways. There's more ways, but we feel like these are the 4 big ways that we, as individuals, have been affected. Lower and broader tax brackets. There's a piece that a CPA from Charles Schwab wrote that highlights these new lower and broader tax brackets for a single filer and a married filing jointly filers that I want to share with everyone at the end of the presentation. And there's a very good visual showing the before and after tax brackets and how those have changed. But generally speaking, the brackets have broadened, they have widened, and they've come down a little bit. Secondly, the standard deduction has increased. In 2017, the standard deduction for an individual was $6,350. The standard deduction for an individual in 2018 is $12,000. It almost doubled per individual. If you're a married couple, your standard deduction is $24,000. And if you file head of household, it's $18,000. But generally speaking, the standard deduction has gone up. As a result, let me take a step back. When you file your tax return, you choose to either take the standard deduction or itemize your deductions. And generally, you're going to take the higher of the 2. You want as many deductions as possible. Because the standard deduction has almost doubled, more and more individual taxpayers will take the standard deduction and not itemize their deductions. And there's consequences of that, and there may be strategies that you can deploy as a result of that, and we'll talk about that here in a moment. The third item that has affected individual taxpayers is the elimination of personal exemptions. Correct me if I'm wrong, Josh, personal exemption for an individual in 2017 is just over $4,000?
Correct.
Those have completely gone away. So as an individual, my wife and I, we've benefited from the standard deduction doubling, but we lose out on the personal exemptions going away. View the personal exemption as another type of deduction that you would get. Those have gone away, and those were approximately $4,000 per individual. Last but not least, one of your if you itemize your deductions, one type of itemized deductions is called your SALT itemized deduction. It's an acronym that stands for state and local taxes. This is your state and local income taxes and your property taxes or real estate taxes. Those have capped, that particular type of itemized deduction is now capped at $10,000. So for individuals that live in New York or California, for example, that have large property taxes, they might pay $20,000, $25,000, $30,000 in property taxes that they were getting an itemized deduction for. That's now capped at $10,000 when you add up all of those deductions. So, one planning concept is to consider bundling some of your itemized deductions in 1 year. For example, you could pay all your property taxes for 2019 and 2020 in 2019. Well, let me take that back. That's a bad example because there's a cap of $10,000. The bundling concept generally is trying to bundle your itemized deductions in 1 year versus spread those out equally over 2 years. I'll give you a better example. Charitable contributions. Charitable contributions are one type of itemized deduction. And if we determine in 2019, for example, that you have total itemized deductions of $22,000, we know that you're simply going to take the standard deduction of $24,000, me and my wife. Again, my itemized deductions total $22,000, but instead of taking that, I'm going to take the standard deduction of $24,000. What I can do is those charitable contributions that I made that are attributable to that $22,000 of itemized deductions, don't make them this year and make them next year. So that next year I have two amounts of charitable contributions in the following year, so that my total itemized deductions in the following year are higher than the standard deduction of $24,000. That's a way that you can increase your deductions over a 2-year period. And I may have fumbled a little bit on the explanation of that, but if you have questions about trying to bundle some of your itemized deductions, I would suggest you sit down with your tax advisor or sit down with your financial advisor at Carnegie. We can go over your specific situation to make sure we maximize your deductions. I'll pause there. Any questions that come to mind? Go ahead.
The salt deduction, the 10,000, is that in the aggregate, or it has to be an individual tax that qualifies up to 10,000?
The question is the salt deduction cap of $10,000. Is that type of deduction in aggregate? So do you mean for a married couple, a husband and wife, looking at?
No, I mean different taxes. Income taxes, 6,000, and I was led to believe that if one of those one tax wasn't over 10,000 or up to 10,000, I wouldn't get a deduction.
I apologize. I don't fully understand your question.
It's all added together.
Yeah, correct. It's all of them added together. Your state income tax, your local income tax, your property tax, all added together. And let's say all of those added together equaled $15,000. Well, you can't take $15,000. It's capped at 10, but you do add them together.
Thank you.
Sure. What other questions come to mind, maybe about the SALT deduction?
No, okay, and then, so the SALT, which is the 10,000 max, that's actually part of, if you're a couple, the 24,000?
Good question. The question is the SALT part of the 24,000? The answer is no. So you have what's called your standard deduction. For a married couple, straightforward, $24,000. You either take the standard deduction of $24,000 or you take the total of your itemized deductions, whichever are greater. One part of your itemized deductions is called your SALT deduction, and that one type of itemized deduction has $10,000 cap on it. But in addition to your SALT deductions, you have mortgage interest deductions, which is a separate itemized deduction. You have your charitable contributions, which are separate itemized deductions.
But that all counts towards that 24. It's to offset, so it's not a separate.
In my opinion, I would view it, and hopefully I'm answering your question, maybe not, just look at what your standard deduction will be,
Yeah.
and then calculate your itemized.
Right, okay.
And take the larger of the two.
Gotcha.
And I apologize if I'm not answering your
I
question.
think I understand.
Okay.
So-
We can address your situation if you'd like separately. Next question. Go ahead, Christine.
The other thing you might want to consider in the bundling is if you have very significant medical expenses and you can, if you get a bill for that near the end of the year, but you know for some reason you're going to have a lot larger bills the following year, you may want to defer payment of that into a year where you're bundling your medical. You've got some threshold you have to get beyond, but that's another bundling concept.
Part of me wanted to bring Christine up here. She's a great CPA that I work with some of my clients. That's a very good point. Trying to bundle some of those itemized deductions in all in one year to get a greater deduction, essentially.
$10,000. If you file jointly, it's $10,000. If you file single or separate, it's 5 each or 10 each. Still,
The question is that SALT cap, what is it if you file married filing jointly versus married filing separately. We haven't talked about married filing separately, but there is different thresholds and different rules for people that file married filing separately. I'll take Christine's word on this, that it's $5,000 cap on the SALT deduction if you file married filing separately. But if you're married filing jointly or an individual, it's a $10,000 cap on that SALT deduction, which again is one type of itemized deduction.